If you own a business and you're dreaming of buying a home, you probably already know how much harder it is to qualify for a mortgage when you're self employed. But harder doesn't mean impossible, it just means a different strategy. The biggest mistake we see business owners make is waiting all the way up until they're house hunting to start planning and preparing. At that point, the lender's rules are already against you. The smart move is planning 2 years in advance to qualify for the home that you actually want. And today we're explaining how you, a business owner, can qualify for the house in the right way. And if you're serious about making this happen, book a call with us using the link in the description below. We'll run through the numbers, look at your cash flow, and help you see what's truly possible. Hi, I'm Erin of Truly Aligned.
And I'm Maximilian of Truly Aligned. We're in the process now of buying our third house as business owners. So we have a lot of experience here and a lot of knowledge that we get to share with you today in the ins and outs of buying a house while you're self-employed. So Aaron, talk about the process that we went through to qualify for our home purchases.
So, the first thing you're going to do is meet with a mortgage lender. And what they're going to do is they're going to look at your income. They're going to request the past 2 years of your tax returns. And they're going to look at your adjusted gross income. This is not all of the income you made, it's your gross income minus all of the deductions that you took. What's left over? And that's what your adjusted gross income is on paper. That's what the mortgage lender is going to use as your income. Now, if you're like most business owners, you're probably taking a lot of deductions because that's what helps you pay the least amount of taxes. And you're probably spending a lot of money on your business. And that's what makes the most sense for you and your growth.
The thing to be aware of in that circumstance is that the more deductions that you're taking, the more you're putting back into the business, that's going to limit how much of a mortgage you can typically afford because it's reducing your adjusted gross income. So most lenders are going to look at what you can pay monthly when it comes to your mortgage. And they do this by taking an average of your income over the past 2 years. That's the adjusted gross income Aaron was talking about,
Mhm.
dividing that number by two, which gives you an annual total payment. Now, that annual total payment includes your mortgage, property tax, insurance, and HOA, if that exists, minus any debt obligations that you have. There are monthly obligations like student loans, car loans, another property, etc.
So, a quick example of this would be, let's use easy numbers. My adjusted gross income over the past 2 years, the average was 240,000. Divide that by two, 120,000 is what I'm able to spend on that total payment throughout the year. Divide that by 12, that means there's a $10,000 monthly payment option for me. But let's say I have an auto loan for $1,000. That means that I can now only spend $9,000 on that total monthly payment.
Now, what we recommend is to try to shoot for to have 30% of your gross monthly income in your total mortgage payment and under
Mhm.
40% for all their debts that you have as far as student loans, cars, and anything that you might be experiencing for debt payments.
Just because you qualify for something doesn't mean we want to be house poor. It's also important to note if your income is variable and it goes up and down month to month, you don't want to overextend yourself and put yourself in an even more stressful position because being a business owner is stressful and buying a house that's at the peak top of what you can afford is also very stressful.
The other pro tip is depreciation. So if you're depreciating like your vehicles or if you have equipment you're depreciating through the business, that can be added back in to increase what you're eligible as far as your overall mortgage goes. So there's a constant trade-off, Aaron, that the amount that you're deducting your taxes directly influences how much you're eligible for your mortgage. So sometimes it's worthwhile to plan 2 years ahead, knowing that potentially you're going to be paying more in taxes or plan out making more money to the business to be eligible for the house that you want. And that's often what we try to advise clients on as well.
So when you are planning 2 years in advance, knowing what you want to qualify for, it's likely you might be spending more money on taxes. But that is the trade off to get your dream home instead of settling for something that maybe not happy with or that you had to buy because that was all you qualified for. So, Max, we've been talking about a conventional loan. Why don't you explain to the people what that is?
So a conventional loan is your best option when you're going to take out a mortgage. The reason behind that, it's going to be the lowest interest rate you're going to get. You typically only have to put 5% down unless you're doing a jumbo loan, which is a higher mortgage. always try this option first. This is the option where they're going to look at your tax returns over the past 2 years to determine how much you're eligible for on your taxes.
Okay, say my income 2 years ago wasn't that great. I took a lot of deductions. Do I have any other options?
One of the other best options is a bank statement loan. A bank statement loan is going to look at what income is coming into the business over the past 12 to 24 months, what's actually hitting your bank account. And in that circumstance, you're going to qualify off your income hitting the bank statement loan versus your tax returns. You don't even need to submit your tax returns in this circumstance. So if your tax return was lower a couple of years ago, it does not impact your eligibility. Now, the downside of this option is typically a full 1% higher than what current mortgage rates are. And there's an additional closing cost as well. The last part, all of these programs require either 10 to 20% down for the house as well. So there are higher fees and more down payment you have to be aware of.
Yeah, and similarly, there is the profit and loss statement loan, which you would provide your profit and loss statement. This is something that comes from your accountant and is approved by them. And this again has the similar terms as the bank statement loan that Max was mentioning. You do have about a 1% higher interest rate, and you have to put 10 to 20% down, and there's additional closing costs. So for both of those two last options, there are more costs up front, and you have a higher interest rate, but it does allow you to qualify if maybe you don't qualify for the past 2 years of income.
And for the profit and loss loan, oftentimes, if you have a business that's doing a lot of depreciation or really complex tax situation, it's often easier to qualify for that versus a bank statement loan. Now, as far as the pro tip, it's really helpful to work with a mortgage broker. And what a mortgage broker is going to do is to shop out different banks to try to find you the most competitive option. Typically, if your house is below $700,000, a lot of times a mortgage broker or a community bank oftentimes can have more competitive rates. What if a mortgage is above 700,000, Aaron? What typically makes sense then?
If you have a higher mortgage, oftentimes the larger banks like Wells Fargo, Chase, they provide more competitive rates and options for those larger loans. So be sure to take a look around and get quotes from each of those types of lenders so that you can compare and decide what to move forward with. And usually they'll start with a pre qualification, which is a soft credit check, and it doesn't impact your credit score like a hard credit check does, so that you can decide who you want to move forward with before you really get into the weeds of it.
And the most important part is to work with a mortgage lender that has experience working with business owners. Most people that buy homes in the United States are W-2 employees, and that's what most mortgage lenders work with. So really crucial that you work with somebody that has experience in your needs. So buying a home as a business owner isn't about gaming the system. It's about aligning your money with your bigger vision, living your ideal life. With the right planning, you can qualify for potentially more, preserve the lifestyle that you want to, and step into your dream home. The crucial part is to not wait. Don't wait until the bank tells you no because you didn't properly plan for it in the future. If you're self employed, you need help to not only purchase your house, but with your other financial goals, book a free consultation with us in the link below. We're here to support you with confidence and clarity. Until the next time,
Stay
stay aligned.
aligned.